We're jumping straight into Brand Engagement Network today. Everyone is watching the price action, but the real story is the global partnership with Valeo Technologies and the breakout into the pharmaceutical sector.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And if you are enjoying the show, do us a huge favor, hit that subscribe button and, smash the like.
It really does help.
It really helps us get this information out there. So today we're cutting through all the noise to figure out one thing.
Just what?
Is this massive, massive move in Brand Engagement Network a classic dead cat bounce? Or are we looking at the start of a legitimate AI turnaround story?
That is the absolute question of the week, maybe the month. Because if you've been watching the charts, you might be feeling a little bit of whiplash right now.
Oh, whiplash is putting it mildly.
Yeah.
I mean, we are talking about a stock that was, for all intents and purposes, in a coma.
Just dead in the water.
Yeah, it was stuck in this brutal 52-week slump, trading all the way down at, what, $1.18? It was completely off everyone's radar. And then just, boom, it wakes up.
And when you say wakes up, you mean it surged 55% in a heartbeat, then pushed even higher, breaking past $16 at its peak.
Right.
That's the kind of move that makes you spill your coffee in the morning.
Absolutely. And usually when you see a micro-cap stock go parabolic like that, your first instinct is to think, okay, which chat room decided to pump this thing today?
Sure, you assume it's just retail traders having some fun.
But the volume tells a completely different story here.
Right, I was looking at the tape. We saw 44 million shares traded recently.
44 million. For context, their daily average is usually sitting around 6 million shares.
Wow.
You just don't get a seven-fold increase in volume from a few day traders. That is a collision of institutional money and massive retail FOMO happening at the exact same time.
Which creates a very dangerous, but also a very exciting environment. People see that ticker moving vertically, they see the percentages flashing green, and they just jump in.
But most of them probably have no idea what actually changed fundamentally to trigger all this.
And that's why we're here, to pop the hood.
Exactly.
Yeah.
Because surprisingly, for a stock that moves like a lottery ticket, there is actually an engine inside this thing. This isn't just a shell company. There's real tech and very specific strategy.
So let's break that down. Because right now, every company on the planet is slapping AI on their homepage and hoping for a valuation bump. What makes Brand Engagement Network different?
It really comes down to one word: compliance.
Compliance.
Yeah.
That sounds incredibly boring.
It sounds boring, but you know what? It's actually the single most lucrative problem in the entire industry right now. You know how everyone loves the big models, ChatGPT, Gemini, all those?
Sure. They're amazing. You can write poems, code a website, plan a vacation.
They are amazing. But they have a fatal flaw when it comes to big business. They hallucinate. They just make things up.
They're like a brilliant improv actor. He sometimes just invents facts to keep the scene going.
That's a perfect analogy. And that's fine if you're asking for a recipe. But it is not fine if you're asking for, say, legal advice.
Or ethical advice.
Exactly. If you're a massive pharmaceutical giant or a global bank, you cannot, under any circumstances, have your AI lying to customers. If a chatbot gives a patient the wrong drug interaction advice because it hallucinated, that company is looking at a class action lawsuit that could cost billions.
So the big general purpose models are just too risky for these highly regulated industries.
Precisely. And that is the moat that Brand Engagement Network is digging. They call it a compliance-first approach. They aren't just wrapping a scan around GPT-4. They have developed their own proprietary engagement language models, or ELM.
Okay.
And they use a structure called retrieval augmented generation.
All right, stop right there. Retrieval augmented generation. We hear that term RAG thrown around in tech circles a lot. But simplify this for the person driving to work right now. What does that actually mean?
Okay, think of it like this. A standard AI model is like a student taking a test purely from memory. They studied hard, they know a lot, but sometimes they forget a detail and they just guess to fill in the blank.
Right. They sound confident, but they might be totally wrong.
Yes, the confident guesser. We all know that student. RE is like letting that student take an open book test, but with really strict rules. Before the AI answers a question, it is required to go to a secure, approved textbook.
Like the company's internal database or a medical journal.
Exactly. Find the exact page, Read the fact and then answer the question using only that verified information.
So it's fact-checking itself in real time against a source of truth before it even speaks.
That's it. It removes the improvisation. And for industries like healthcare, that's the difference between banning AI and adopting it. And get this, Brand Engagement Network has 21 issued patents specifically covering this architecture.
21 patents. That's not a small number for a company this size.
No, it tells me they've been working on this for a long, long time, not just chasing the current hype cycle. They've built a wall of intellectual property around being the safe AI.
And that tech is finally starting to show up in the turnaround story. Because if you looked at this company a year ago, purely on the numbers, it was ugly.
It was a cash bonfire, wasn't it?
Pretty much.
But look at the second quarter of 2025. They pulled off a massive financial pivot. They swung from a $3 million loss to a $900,000 net income.
Wait a second. They actually posted a profit? That is incredibly rare for a microcap AI stock.
They did. Now, there is some important nuance to that profit, which we'll get to in the bear case. But the most impressive part was the discipline. They cut operating expenses by 55.6%.
Over 50%. That is a hatchet job on expenses.
It is. They just stopped the bleeding. They realized they couldn't just burn cash forever, so they tightened the ship. And that stability gave them the platform to land the deals that are driving this current stock price explosion.
Okay, so let's talk about those deals, because the headlines are flying. The big one seems to be Valeo Technologies.
Yes, Valeo. This is their deal focused on Africa and the Middle East. And this isn't just a standard licensing deal where they hand over the software and get a monthly check.
Oh, how so?
It's a $2.05 million deal, yes. But Brand Engagement Network also gets a 25% equity stake in the new entity they're forming with Valeo.
Wow.
Plus, they get a 35% revenue share on all sales.
Oh, okay. So they're not just a vendor. They're practically a co-founder. They own a quarter of the business.
Correct. They are planting a flag in an emerging market with a local partner. If Valeo takes off in Dubai or South Africa, Brand Engagement Network gets a cut of every single dollar, plus they own the asset. It's a long-term play.
And then you layer on the pharma deal. This is the one that really caught my eye. A top 10 global pharmaceutical client.
The mystery client. They can't name them yet because of NDAs, which is totally standard in that industry. But they secured a vendor agreement through a major ad agency to build a custom AI engagement solution.
And that goes right back to your compliance point. A top 10 pharma company isn't going to sign a deal with some fly-by-night AI wrapper. They have armies of lawyers.
Absolutely not.
So if they're signing a vendor agreement, it means the safe AI pitch worked. It's validation.
It's the ultimate validation.
Yeah.
And the logic is, right, if you crack the code with one top 10 pharma company, the other 9 have to start paying attention. Sets a standard.
Plus, they have that partnership with Swiss Life, which gets them into the European financial and insurance market.
So you've got pharma, finance, and international expansion all hitting the news cycle at once. And that's the bull case. Proprietary tech, a patent moat, a management team that cut costs, and now global partners validating the whole thing.
Put it that way, and it sounds like an absolute slam dunk. It sounds like the stock should be at $50.
It does sound like that.
But I know how this works. We don't just read the press releases. We have to look at the ugly stuff.
We do. And we have to be honest. There is a very messy corner of this room that we need to shine a bright light on.
Okay.
Because if you only look at the headlines, you miss the risk. And the risk here is it's substantial.
All right, let's get into the bear case. What's the reality of the bank account?
The first reality check is revenue. Actual current revenue. We just talked about these multi-million-dollar deals and pharma potential. But if you look at the last reported quarter, Q2 2025, their recognized revenue was $5,000.
I'm sorry, did you say 5,000 as in 5?
$5,000. That's it. And their trailing 12-month revenue was only around $75,000.
That's tiny. I mean, a decent local coffee shop makes more than that in a month.
Exactly. So right now, the market cap is pushing $70–80 million. You are paying for future promises. You are paying for what you hope they earn in 2027. The valuation is completely detached from what they're banking today.
So it's a pure speculation play.
Yeah.
But hang on, you said they had net income of $900,000. How do you get that from $5,000 in sales?
That's the nuance I mentioned. A lot of that profit was from accounting gains, specifically a gain on debt extinguishment.
The old paper shuffle.
Basically, they restructured some debt, and on paper, that counts as income because a liability disappeared from the balance sheet. It wasn't cash coming in from customers.
That's a classic trap. You see net income positive on a screener and think business is booming.
Correct. And that brings us to the most alarming part of the bear case, the liquidity crisis.
Okay.
This is the part that should make every investor pause. We look at the quick ratio. It measures a company's ability to pay its immediate debts with cash. Their quick ratio is 0.01.
0.01. So for every dollar of bills due right now, today, they have 1 penny.
1 penny. And their current ratio is 0.15. They're critically undercapitalized. They're running on fumes.
That explains the volatility. When a company is that cash poor, bankruptcy isn't a distant threat. It is knocking on the front door.
And this creates the dilution danger. If you're cash poor, but your stock price just exploded because of good news, what is the only rational thing to do?
You sell stock, you raise money immediately while the price is high.
Exactly. They have to raise capital to fund these pilots. Implementing that Valeo deal, or the pharma pilot, costs money up front. They need cash, so they will almost certainly issue new shares.
Which dilutes the existing shareholders. My slice of the pie just got smaller because they had to pay the electric bill.
Precisely. And speaking of the pilots, that's the execution risk. That pharma deal, it's a pilot. It's a vendor agreement. It is not a 10-year guaranteed contract.
Right. A pilot is a date. It's not a marriage.
Exactly. If that top 10 client decides after 6 months, this is a little clunky, and they cancel, the entire revenue narrative collapses. You're left with a company making $5,000 a quarter with massive debts.
So the entire bull case rests on these pilots converting into permanent paying contracts.
That is the gamble. And that uncertainty is why you see the microcap volatility. I mean, we are seeing average weekly price movements of 42%.
42% swings in a week? That is not an investment. That's a roller coaster.
It is. You could be up 50% on Monday and down 30% by Wednesday. This is not a stable stock for your retirement fund. This is a high-risk, high-reward battleground.
So we have a really clear split here. Incredible tech potential and patents on one side, and a terrifying balance sheet on the other. For listeners trying to figure out what to do, what are the road signs, what happens next?
You have to watch the triggers.
Yep.
The next 30 to 90 days are absolutely critical. I'm watching 3 specific things.
Okay, give me the watch list.
First, Q4 earnings, expected late February or March 2026. This report is going to be the moment of truth.
What are you looking for specifically?
We need to see if that $2.05 million from Valeo hits the books. If that money is recognized, their revenue jumps from $5,000 to over $2 million instantly. That changes the entire valuation.
That would validate the growth story immediately. But if they report and that revenue line is still empty,
then look out below. We also need to see guidance. Management promised an improved outlook. Investors need to see them raise the numbers for 2026. If they come out and say we're still cautious, the stock could tank.
what's the second trigger?
Pilot conversions. You have to keep your eyes peeled for any press release about that top 10 pharma client. We want to hear words like full rollout, expansion, or multi-year contract.
And silence is deadly there.
If we go 3 months without hearing about that client, you have to assume the pilot stalled. Also, watch the Nelson Mandela University pilot. They're testing a mental health AI platform there. It sounds small, but it could be a gateway to government contracts in South Africa.
Okay, and the third thing?
NASDAQ compliance. They've been fighting to stay listed. To stay on the NASDAQ, you generally need to keep your bid price above $1.
They're well above that right now, though.
They are today. But in this kind of volatile stock, you could lose 50% of your value in a week. If the stock crashes back below $1, the fear of delisting returns, and the big institutional money won't touch it.
So it's a compressed timeline, late February earnings, news on the pharma rollout, and maintaining that dollar threshold. It's going to be a stressful few months for anyone holding this stock.
Stressful, but potentially very, very lucrative.
So let's wrap this up. We've seen the massive upside, the patents, the partnerships. We've seen the scary downside, the lack of cash, the dilution risk. What's the final verdict?
This is what we call an asymmetric trade.
Meaning the potential win is much larger than the potential loss.
Exactly. Look, you can only lose 100% of your money. The floor is 0. But the upside. If they actually capture the regulated AI market, if they become the standard for safe AI in pharma and finance, this company is worth multiples of what it is today. We're talking multi-bagger potential.
But it's binary. It's not going to be a steady gainer. It either works big or it fails hard.
Correct. It really comes down to one question you need to ask yourself. Are you betting on the patents and the partnerships, or are you running from the balance sheet?
That's a tough call. But that's why we look at the data.
Exactly. And that is the lowdown on Brand Engagement Network. If you found this breakdown helpful, remember to subscribe and like the show. We'll be back with another one soon. Until then, trade smart.
See you next time.